I will never forget the look on my daughter's face the day she received her first paycheck. A few summers ago, her track and field club hired her as a junior counselor, promising her an hourly wage of $20. Before she had even started, she began to calculate the amount of her first paycheck. Assuming a 15-hour work week, she figured she would receive $600 every 2 weeks, not bad for a first job. Fast forward 2 weeks, and the day she had been looking forward to had finally arrived, payday. I dropped her off at the track and field club, ran a few errands, and returned to pick her up later in the day with the expectation that she would be in a great mood. Was I ever wrong? The instant she hopped into the car, she complained about what she considered to be an error with her pay. She was certain that she should have received $600, but her paycheck was only in the amount of $495. On this day, my daughter learned two valuable lessons. Firstly, for any economic activity, whether it be consumption, earnings, investment income, or capital gains, the government will take a piece of the pie. And secondly, if someone promises to pay a 16-year-old $20 an hour tax-free, you better believe that it is too good to be true. From an investment management perspective, taxes are one of the greatest threats to our financial wealth. Unfortunately, most people live day to day conforming to the idea that they have no control over the taxes that they pay. Over the course of this chapter, we will explain the nature of how taxes are charged on equity and fixed income returns, illustrate the extent to which taxes can limit our ability to save enough money to last the entirety of our retirement years, and lastly, provide solutions for how we, as investors, can limit our tax liability. Before we discuss the impact of taxes on our financial wealth, it is important to understand how these taxes are charged. Despite the endless means by which the Canadian government taxes its citizens, we will focus on three outlets that have the most significant impact on investment returns: taxes on interest income, taxes on dividend income, and taxes on capital gains. For all three channels, we will provide an example to compare the differences of each tax structure and the ultimate impact on the investor's return. Let's begin with interest income. Interest income, the income received from a fixed income security, is taxed at the investor's marginal tax rate without any preferential tax treatment. Since interest income is taxable in the year it is received, and investors have no control over the year the income is paid, they have no control over when they will pay their tax liability. In other words, when an investor receives interest, they are immediately liable for the associated taxes. For example, assume an Ontario investor owns a $1 million corporate bond paying semi-annual coupon payments of 2%. Since the investor's 2018 gross employment income amounted to $150,000, her combined federal and provincial marginal tax rate is 47.97%. Over the course of 1 year, the investor would receive $40,000 in gross interest payments. As a result, she would incur a tax liability of $19,188 since interest income is charged at the investor's marginal tax rate without any preferential tax treatment. After all is said and done, the investor's net return would be $20,812. Since the investor had no control over the interest payment schedule, she had no control over the timing of her tax liability. Let's examine dividend income. Similar to interest income, dividend investors are limited in their ability to control the timing of their tax liability because they cannot control the time at which the dividends are paid. Instead, the company's board of directors agree on a dividend payout schedule, and the investor's tax liability is incurred on the same day the dividend payment is made. While both dividend and interest-seeking investors do not have any control over the timing of their tax liability, the magnitude of the tax charged on dividend income is lower than that charged on interest income as a result of preferential tax treatment for shareholders in dividend-paying companies. This preferential tax treatment is an initiative by the government to motivate investment in Canadian companies. In addition, since companies pay dividends from after-tax profits, In other words, the dividends have already been taxed at the corporate level. Preferential tax treatment for shareholders in dividend-paying companies aims to eliminate double taxation. This preferential tax treatment for dividend income is provided through the dividend gross-up and tax credit mechanism. The following example provides an illustration as to how this mechanism is carried out. Assume the same investor from our previous example decides to invest $1 million in a publicly traded Canadian company paying an annual dividend of 4%. Instead of purchasing the corporate bond, since the investor's 2018 gross income amounted to $150,000, her combined federal and provincial marginal tax rate is 47.97%. As we will show through our next example, once the dividend gross-up and tax credit mechanism is put into effect, the investor's effective tax rate for Canadian eligible dividends will amount to 31.67%, significantly lower than what would be taxed had she invested the $1 million corporate bond. In the text which follows, I have provided a step-by-step breakdown of how the gross-up dividend tax and dividend tax credit are applied. The investor receives 4 gross dividend payments amounting to a total of $40,000. On the investor's tax return, her $40,000 in dividends is grossed up by 38% to $55,200. The gross-up represents a return of the taxes that were previously charged at the corporate level. This gross-up is applied in an attempt to eliminate double taxation. Now that the total dividends are free from tax at the corporate level, the investor's marginal tax rate of 47.97% is applied to the total grossed-up dividends. As a result, the gross tax liability is calculated to be $26,479. The combined federal and provincial dividend tax credit in 2018 is 25% of grossed-up dividends. In our example, the dividend tax credit is calculated to be $13,811. After the tax credit is applied, the investor's net tax liability is calculated to be $12,668. The $12,668 tax liability is equivalent to a 31.67% effective tax rate for Canadian eligible dividends. As we have seen through our previous example, while interest-seeking investors and dividend-seeking investors may have the same level of control over the timing of their tax liability, preferential tax treatment is provided to those who invest in dividend-paying stocks over fixed-income securities. Let's take a look at capital gains and how they're taxed. The tax paid on capital gains differs from that paid on interest and dividend income because investors have the ability to control when they will pay their tax liability. Investors have this control because taxes on capital gains are only triggered when an investor sells their security and realizes their gain or loss. Prior to this point, the gain or loss is considered to be unrealized since the security still has the potential to fluctuate in value. In addition to being able to control the timing of their tax liability, investors also have the ability to use capital losses to offset their capital gains and lower their overall tax liability. We will illustrate how capital gains taxes are charged in Canada through the following example. In Canada, 50% of capital gains are taxed at the investor's marginal tax rate. In this example, we will assume the same investor from our previous 2 examples decides to purchase $500,000 of stock A and $500,000 of stock B instead of purchasing the corporate bond or Canadian dividend-paying company. It is important to note that both stock A and stock B do not pay a dividend. Over 1 year, stock A increases in value by $80,000 and stock B decreases in value by $40,000, representing a combined unrealized capital gain of $40,000. At the end of the year, the investor decides to sell both stock A and stock B, realizing her combined gain of $40,000. As mentioned in our previous examples, since the investor's 2018 gross income amounted to $150,000, her combined federal and provincial marginal tax rate is 47.97%. The following step-by-step list summarizes the nature of how the tax liability would be charged and how the investor uses the capital loss from stock B to lower her overall tax liability. Despite the fact that the investor generated an $80,000 capital gain off the sale of stock A, she can use the $40,000 loss from stock B to lower the total capital gain subject to taxes. Therefore, rather than being taxed individually on the $80,000 capital gain from stock A, the investor is taxed off the $40,000 combined capital gain from both stock A and stock B. Capital losses have not been used to reduce a tax liability in prior years can be brought forward and used to reduce a tax liability in the current year. As mentioned, in Canada, 50% of capital gains are taxed at the investor's marginal tax rate. Since 50% of the investor's combined capital gain amounts to $20,000, only $20,000 is subject to being taxed at the investor's marginal tax rate. As a result, the investor's total tax liability amounts to $9,594. From the previous example, not only did the investor have control over the timing of her tax liability, the magnitude of her tax liability was also lower than the taxes charged on interest income and dividend income. In fact, at a marginal tax rate of 47.97%, her effective tax rate for capital gains was only 23.98%. Let's take a look at how taxes destroy long-term performance. As previously mentioned, taxes are one of the most detrimental threats to reaching our long-term investment objectives. To illustrate this point, we will take a look at an example where an investor holds a portfolio of only fixed income securities. For simplicity, let us make the following assumption. The investor will invest $1 million for 25 years. The portfolio will earn an annual rate of return of 3%. For simplicity, we will assume that the investment pays interest income once per year and the investor chooses to reinvest the proceeds into the same investment. The investor's marginal tax rate will be fixed at 45% in this example. If we compare the return of the investor's portfolio over a 25-year period with and without taxes, it becomes evident that the taxes actually limit the investor's return by significantly more than his 45% marginal tax rate. In fact, without taxes, the investor's initial investment of $1 million was able to grow 55% more, or to $551,718 more than the investment with taxes. If both investments are identical, other than the fact that one incurs an annual tax liability of 45% and the other does not, how can the difference in returns exceed 45%? Put simply, when an investor reinvests the proceeds from his or her original investment, his investment will now earn a higher dollar return in the following year because the interest is compounding on a higher amount. For example, in the first year of the investment period without taxes, the investor earned $30,000, or in percentage terms, 3%. In the second year, he earned an additional 3%. However, this time the 3% was generated off the original principal plus the return generated in the previous year. Therefore, the 3% return in the second year was actually generated off of $1,030,000, amounting to an annual return of $30,900. Since the investment was with taxes compounds off a smaller amount of previously generated returns year after year, the investment with taxes increases at a slower rate than the investment without taxes. Using the knowledge obtained from previous chapters, can you remember the name of the investment tool responsible for the 55% difference in returns from the previous example? If you guess compound interest, you have been paying attention. Since taxes on investment income continually reduce the investor's return throughout the investment period, the total dollar amount from which all prior year returns can be compounded is reduced. To summarize, taxes are detrimental to our financial wealth because they limit our ability to make use of the power of compounding interest. It is important to realize that taxes had a significant impact in our previous example because the investment return was made up of strictly interest income. Therefore, the investor was taxed at their marginal tax rate with no preferential tax treatment. To make matters worse, the investor also had no control over the timing of his tax liability. In the final subsection of this chapter, we will explain how Canadians can reduce their overall tax liability from interest income. dividend income, and capital gains by optimally allocating certain asset classes to be held within specific investment accounts. This strategy is also referred to as asset location. Let's discuss asset location a little further. In Canada, investors can hold their investment securities within a number of different investment accounts. A few of these accounts offer unique tax-sheltered and tax benefits, providing investors with a platform to optimally allocate asset classes to the account type that will minimize their overall tax liability. In this subsection, we will explain how investors can reduce their overall tax liability through making proper use of the following three account types. Firstly, non-registered. Secondly, RRSPs. Thirdly, tax-free saving accounts or plans. It is important to note that these three accounts happen to be the most common account types in Canada. In reality, there are a number of additional account types that offer more specific yet similar tax reduction benefits. Let's examine non-registered accounts. A non-registered account is the most standard basic account offered to Canadians. The account offers no tax benefits and imposes no restrictions on withdrawals or contributions. With RRSPs, a RRSP shelters all securities within the account from taxation until the investor decides to withdraw funds from the account. In other words, regardless of whether an interest payment is made, dividend payment is made, or the investor chooses to sell their securities and realize a capital gain, no tax liability is applied. If the investor chooses to make a withdrawal, the funds withdrawn are taxed at the investor's marginal tax rate. The three main benefits of an RSP are as follows. The individual tax laws for each asset class is eliminated. In other words, regardless of whether the security generates an investment return, dividend return, or capital gains return, the tax liability is calculated by multiplying the investor's withdrawal amount by his or her marginal tax rate. The second benefit, since the tax liability only applies if the investor decides to withdraw funds from his or her account, investment returns are able to compound tax-free. Once again, all investment returns will not be taxed. Only at the point in which the investor chooses to make a withdrawal will the amount withdrawn be taxed at the investor's marginal tax rate. Thirdly, an RSP provides investors with a complete control over the timing of their tax liability. As we know, investors of interest and dividend-paying securities have no control over the timing of their tax liability if the securities are held in a non-registered account. However, since the RSP creates a unified tax system for all asset classes, a tax liability only applies once the investor decides to withdraw funds from the account. In addition to the benefits previously listed, Canadians are able to lower their taxable income by making contributions to their RRSP. With that being said, we do not consider this to be a benefit from an investment management perspective. Therefore, it has not been included in the previous list. With respect to restrictions, Canadians are limited in the annual amount they can contribute to their RRSP. This amount depends on multiple parameters that are specific to the investor. Therefore, we will not be covering this topic in our book. Let's take a look at tax-free savings accounts for a moment. While an RSP offers tax-sheltered benefits, the tax-free savings account completely eliminates taxes associated with interest income, dividend income, and capital gains altogether. In addition, any amounts that the investor withdraws from their account are not taxed and can even be recontributed to the same account in the following calendar year. The main drawback with the TFSA is that the contribution room is extremely low relative to that of a non-registered or RRSP. Now that we have an understanding of the benefits and limitations associated with each account type, we can take a look at how investors can reduce their overall investment tax liability by properly allocating securities among these accounts. Let's begin with interest-paying fixed income securities. Early in this chapter, we provided 3 examples of a single investor who generates a $40,000 return in the form of interest income, dividend income, and capital gains. The results proved that interest income is associated with the largest tax burden for the following reasons. Firstly, investors are taxed at their marginal tax rate and no preferential tax treatment. Secondly, investors have no control over the timing of their tax liability. For these reasons, to minimize an investor's overall investment tax liability, I believe the investor's first priority should be to hold interest-paying securities within an RRSP. As previously mentioned, one of the main benefits associated with an RSP is that the playing field becomes level since a unified tax system applies for all securities held within the account. By holding the security with the largest tax burden within an account that levels the playing field, the investor's overall tax liability should be minimized. You should also note at this point, you may be curious as to why we would not choose to hold interest-paying securities within a TFSA, since the tax liability would be eliminated entirely. Of course, this option would also be ideal. However, given the extremely low TFSA contribution room available relative to that of RSPs and non-registered accounts, most investors are likely to hold the majority of their investment securities within an RSP or a non-registered account. Therefore, the more relevant comparison from an asset allocation perspective is whether to allocate a specific asset class towards an RSP or a non-registered account. With that being said, since the tax reduction benefits of the TFSA are so similar to that of the RSP, it is safe to assume that if a security should be held within an RSP over a non-registered, it should also be held within a TFSA over a non-registered and vice versa. A more relevant discussion of TFSAs versus RSPs surrounds the topic of whether an investor should prioritize making contributions to their TFSA or to their RSP. In this case, the ultimate trade-off is whether the investor would prefer liquidity provided by the TFSA over the taxable income reduction associated with making a contribution to his or her RSP. While this discussion is important, it is beyond the scope of this book. Let's now turn to non-income producing securities. Securities that generate a return entirely through capital gains should ideally be held within the investor's non-registered account for the following three reasons. Firstly, the investor has complete control over the timing of their tax liability. Therefore, it would be optimal to hold as many of the investor's interest-paying and dividend-paying securities within an RRSP or TFSA and hold the securities where the investor has control within a non-registered account. Secondly, for investors with a high marginal tax rate, then the effective rate for capital gains, selling a security, realizing the gain, and then withdrawing the proceeds from the account would result in a larger tax liability if the security was held within an RRSP. Thirdly, equity securities that do not pay a dividend and strictly provide investors with a return on capital gain arguably be regarded as riskier. We will explain this point a little further in Chapter 8. Therefore, if any of these securities end up losing value, the investor can use the capital losses to offset capital gains and lower their overall tax liability. In an RSP or TFSA, the investor cannot make use of this strategy. Let's focus our attention on dividend-paying equity securities for a moment. As for equity investments that pay a dividend, ideally it would be beneficial to hold these securities within an RSP, since the investor would control over the timing of their tax liability. With that being said, it is important to remember that the magnitude of the tax liability for dividend-paying securities is lower than that of interest-paying securities as a result of the preferential tax treatment provided to shareholders in dividend-paying companies. Therefore, if the investor has a large enough portfolio to the point where the dividend-paying securities could only be held in the RSP at the expense of holding interest-paying securities, the dividend-paying securities should be held within the non-registered, since the investor's overall tax liability would be higher if the interest-paying securities were held within the non-registered account. In the following chapter, we will discuss the final two threats to our financial wealth, the media and the investor. Following this, we will introduce the benefits of dividend growth investing and explain why it is the most efficient investment solution to combat each of the many threats to our financial wealth.